The S&P 500 just hit its 16th all-time high this year. The Dow Jones Industrial Average crossed 50,000 for the first time in history. The Nasdaq Composite is up 22% year-to-date. And the VIX, which is the official name for the Fear Index, the measure of how much investors are paying to protect themselves from a crash, is sitting at 11.78, its lowest level in over 3 years. That is a market that, on paper, looks like everything is fine. Maybe even better than fine. It looks like the kind of environment where everyone should be feeling pretty good about their money. But here's the strange part. The University of Michigan Consumer Sentiment Index, one of the oldest and most respected measures of how Americans actually feel about the economy, just posted a reading of 44.8. That is an all-time low. Not a recent low. Not the lowest since the pandemic. The lowest ever recorded, going back to the 1950s when they started tracking this number. Lower than the 2008 financial crisis. Lower than the pandemic inflation panic of 2022. Lower than anything. Americans are reporting that they feel worse about the economy today than they did when the banking system was collapsing in 2008. And yet the stock market is at its highest point in history. So which one is right? The market, with its relentless climb to new records? Or the people, with their historically grim view of the financial world? The answer is neither, and both, and the reason why isn't about economics. It's about your brain. This is Wealth Unlocked, and today we're going to talk about the most dangerous force in personal finance, not inflation, not interest rates, not geopolitical risk. It's the 2.5 pounds of tissue sitting inside your skull that evolved to spot tigers on the savannah, not to navigate a market with a Shiller CAPE ratio of 44. Let's start by understanding what's actually happening. We have two completely different data sets telling opposite stories, and the gap between them is the signal. The market is forward-looking. It prices in expectations of corporate earnings, interest rate trajectories, technological disruption, and global trade patterns 6 to 12 months out. When the S&P hits a record at 7,486, it's saying that the collective wisdom of millions of buyers and sellers expects the future to be better than the present. Consumer sentiment, on the other hand, is backward-looking. When someone calls a survey and says they feel terrible about the economy, they're describing what they experienced yesterday. The price of gas at $4.55 a gallon. The grocery bill that somehow got more expensive again. The news about the Iran conflict and oil above $100. Two different time horizons, moving in opposite directions, both perfectly rational from their own perspective. But here's what happens next. When the average person sees this disconnect, their gut screaming that things are bad while the market keeps going up, their brain starts searching for explanations. And this is where the behavioral biases kick in, one after another, like dominoes. The first bias is anchoring. Anchoring is the psychological tendency to fixate on a specific reference point and judge everything relative to it, even if that reference point has no rational connection to current conditions. If you started investing in 2009 when the S&P was around 1,500 after the financial crisis, your anchor is 1,500. From that perspective, every single price since 2009 feels like you missed the boat. If you started during the pandemic lows of 2020, your anchor is around 2,200. If you started after the 2022 correction, your anchor is closer to 3,600. Everyone's anchor is different, but the effect is the same. The current price always feels too high. The data tells us that this feeling is almost entirely noise. Since 1950, the S&P 500 has hit a new all-time high on approximately 1 out of every 8 trading days. Not once a decade. Not once a year. 1 out of every 8 days. That means the market spends most of its time within 5% of its own record. The idea that an all-time high is a rare, dangerous event that you should avoid is demonstrably false. JP Morgan ran the numbers on this. They looked at every trading day since 1980 and compared what happened when you bought at an all-time high versus any other day. The result? Buying at all-time highs outperformed buying on other days over 1 year, 3-year, 5-year, and 10-year periods. The only time it didn't was after the dot-com peak, and even then, a 10-year hold from the year 2000 peak still delivered a positive nominal return, just a lower one than the average. So anchoring is making you feel like the market is dangerous when the historical data says it's actually business as usual. But anchoring is just the first domino. The second bias is loss aversion, and this one cuts deeper. Daniel Kahneman and Amos Tversky, the psychologists who basically invented the field of behavioral economics, demonstrated something remarkable in their prospect theory research. They found that losses hurt roughly 2.5 times more than equivalent gains feel good. Losing $1,000 doesn't just cancel out gaining $1,000. It takes gaining about $2,500 to produce the same emotional impact as losing $1,000. That asymmetry is built into every human brain. At record highs, loss aversion goes into overdrive. When the market is at a high, investors feel like they have more to lose. Their portfolio is bigger than it was, so a 5% drop represents a larger absolute loss. This creates an intense psychological pressure to sell, to lock in gains, to get out before the crash that must be coming. But selling at a record high because you're afraid of losing imaginary future gains is the behavioral definition of buying high and selling low. You bought at some lower price, held during the climb, and then sell at the top because you can't handle the anxiety. And then the market keeps climbing, and you sit in cash watching the gains you could have had. This is reinforced by recency bias, which is the tendency to overweight the most recent information. After an 11-day V-shaped recovery from a 5 to 10% drawdown, which is exactly what happened in May of this year, recency bias makes the drop feel like a blip that's already over. Investors interpret the speed of the recovery as proof that the rally is unstoppable, and FOMO kicks in. So you have loss aversion pulling one direction, anchored to your fear of a crash, and FOMO pulling the other direction, driven by the recency of the recovery. Both forces are active simultaneously, and that tension is the worst time to make a decision. The research firm DALBAR publishes an annual study comparing investor returns to market returns. The finding is consistent every year. The average investor underperforms the S&P 500 by roughly 3 to 4% annually. Over a 30-year career, that difference compounds into hundreds of thousands of dollars. And the primary cause isn't picking bad stocks. It's behavior. Investors buy at peaks when FOMO is strongest, and they sell at troughs when fear is strongest. The gap between what the market returns and what investors earn is almost entirely explained by bad timing driven by emotion. So what's the solution? The answer is boring, unglamorous, and mathematically unbeatable for the vast majority of people. Dollar cost averaging into low-cost index funds on a fixed schedule, regardless of price. Here's why it works. Dollar cost averaging neutralizes both FOMO and fear. When you invest the same amount every month, $500, $1,000, whatever you can afford, you automatically buy more shares when prices are low and fewer when prices are high. You don't need to decide whether now is a good time. The decision was made when you set up the automatic transfer. And crucially, you stay invested through the full cycle. You're buying at the highs, you're buying at the lows, and you're never making a panic sale because you never need to decide when to get out. The academic data on dollar cost averaging versus lump sum investing is worth understanding. Lump sum investing, putting all your money in at once, beats dollar cost averaging about 66% of the time in rising markets, purely because time in the market beats timing the market. But dollar cost averaging wins behaviorally because it keeps you in the game. Someone who lump sums in, panics during the first 10% correction, and sells at the bottom has a worse outcome than someone who dollar cost averages through the entire cycle. The behavioral edge is real, and for most people, it's worth more than the mathematical edge of lump sum investing. And here's the most counterintuitive part. Even if you're right that the market is overvalued, being right about valuation doesn't help you with timing. The Shiller CAPE ratio is at 44, which is the second highest in 145 years of data. The only time it was higher was during the dot-com bubble. But the CAPE was above 30 for nearly the entire period from 1997 through 2000, and the S&P 500 returned 42% in 1998 and 21% in 1999. High valuations mean lower expected returns over the following decade. They do not mean an imminent crash. Someone who sold in 1997 because the CAPE was high missed out on some of the best years in market history. They were right about valuation and completely wrong about what to do about it. So here's the practical takeaway. If you're already invested, stay invested. The worst thing you can do at an all-time high is sell in anticipation of a dip you cannot predict. If you're sitting in cash because you've been waiting for comfort, understand that comfort is a lagging indicator. By the time you feel comfortable investing, the market will likely be higher than it is today. The best time to start dollar-cost averaging is always now, and it becomes more urgent the longer you wait. If nothing else, just name the biases when you feel them. Say it out loud. I'm anchoring to an old price. My loss aversion is telling me to sell. I'm in FOMO mode because I see everyone else getting returns I'm not getting. Just naming the mechanism reduces its power over your decisions. That's not pop psychology. The research shows that labeling an emotional state activates the prefrontal cortex and reduces amygdala response. You literally make better financial decisions when you call the bias by its name. The stock market is at a record high, and your brain is telling you that's a problem. But the data says that record highs are normal, buying at them has historically worked out well, and the most expensive mistake you can make is not staying invested through them. Your brain evolved to spot threats in a world of immediate physical danger. It did not evolve to compound wealth over 30-year horizons. The gap between what your instincts tell you and what the math actually says is the gap between being an average investor and a wealthy one. Understanding that gap is not financial advice. It's financial literacy. And it's the most important thing you'll learn all year. This is Wealth Unlocked. Subscribe for more financial literacy, not advice. And remember, the market doesn't care how you feel about it.